Hi, this is Morgan Smith, your host for Top 10 Investing Myths. I'm a partner and financial advisor with WorthPoint. We can be found at worthpointinvest.com, and I work with families and business owners with their wealth management and financial planning and investment management. And I'm here with my special guest, Apollo Lupesco, PhD, Vice President, Dimensional Fund Advisors, the Secretary of Explaining, world-renowned speaker. How you doing, Apollo?
Good to see you, Morgan. I'm doing well. How are you?
I'm doing great. So let's have a look at our myth here. I often hear this with some clients that they're just kind of wondering, like, if I want to grow money, why do I need bonds in my portfolio? And oftentimes, um, for example, perhaps in the last year, maybe their experience in the with fixed income or bonds, it just hasn't been what we would call stellar returns. And so, really, what we want to cover is whether or not bonds really do have a role in a portfolio. My experience tells me there's things you have to look at whether or not bonds are relevant in a portfolio. One of them is, how do you feel personally about risk? How can you handle and accept risks? The other is whether or not somebody is in a distribution phase in an investment portfolio. Are they taking money out now? But generally, just so you know, Apollo, before you go into this, our philosophy is, as a firm, generally, I mean, obviously, we customize portfolios, is really number one, investment philosophy standpoint, bonds should be the safe harbor in your portfolio, kind of your anchor. You take your risk in your equities because that's where you get your return. And typically, what we like to look at is lower duration, number one, high credit quality, number two, and globally diversified, number three. And those are the three qualities we look at from a bond portfolio. But talk to us. Do you really, what evidence do we have that bonds are appropriate in a portfolio?
Yeah, and first of all, Morgan, I think you kind of really touched on something really important. I don't think that anybody, myself included, ought to recommend something to you, the investor, without knowing your circumstances. When we're talking about are bonds appropriate for you, are stocks appropriate for you, it could be. It just really depends on your circumstances. How much money you need, when do you need the money, what's your risk capacity, all these different factors. And only once an advisor understands this and develops a financial plan, then we can talk about whether or not the bonds are appropriate for you. So bonds might be appropriate for some people, but not necessarily as much for others. But the broad concept here, are bonds really still something that you ought to consider? It's really important because for many years, the interest rates on these bonds are low, and people are saying, well, why even bother with these bonds? I'm not making much on them. And last year, interest rates went up, but you saw losses in the portfolio. And then once again, it's like, well, yeah, I'm losing money, so why have bonds? So let's talk about what bonds are to begin with. And I'll give you the punchline. Absolutely, for some people, I do believe that some bonds are appropriate for certain people, not for everybody. And even within bonds, we'll touch on which ones might be more appropriate than others. But let's start with the fundamental. I think a lot of folks are relatively comfortable with the stock market. The stock market is about ownership in companies. If you buy a share of a company, you say Google or Apple or McDonald's or you name it, United Airlines or Delta Airlines, what you get is a slice of ownership. So you are now part owner into that company, into that business. And as part owner, you are entitled to part of the profits that the company makes. And the value of the ownership depends on what do you expect to make. Now, in any business, profits fluctuate. And as profits fluctuate, as earnings fluctuate, so does the value of a company and what you are expected to receive. So there's a lot of uncertainty in the stock market because, again, you are just taking part in the profits that a company makes. It just turns out that nobody really knows what a company will make for years and years down the road. But if you look over the long run at the stock market, if you take the last 90 plus years of data that we have in the stock market, what you see is that stocks have delivered returns of about 9-10% per year on an annualized basis. That's the average annualized per year. Now, from year to year, this has been a very choppy ride. So, just because you see the average, you're not going to get it. So to me, I start with the stocks because people have a good understanding of what the stocks might be. It's just ownership in companies. You go to the stock market, you buy it, and over the long run, it has delivered this 9-10%. Just to make it real, because 9-10%, it might not seem like much. And we do have this book called the Matrix book. And the Matrix book is a phenomenal book. It's on my desk. I always kind of have it with me. And the Matrix book basically allows us to see the growth of a dollar, and in the case of the S&P 500, if you go back to the 1920s, a dollar, a single dollar invested in the stock market by the end of last year, you would have grown to roughly about $11,000. So quite a significant growth in the stock market. So that's what the stocks are. We're familiar with those. Now, what are bonds and how are they different than stocks? Well, bonds are not about ownership, but it's about lending. Instead of buying ownership in company, having no idea what you might get, in the case of bonds, you are lending your money to the US government, to other governments, to corporations around the world. And what happens when you lend your money, there's a contract, and the contract specifies what interest rate will you receive on your money, for how long the contract lasts, and then at the back end you get your money back. So the difference between stocks and bonds is, in the case of bonds, there is a interest rate stipulated into a contract, and if a company doesn't pay you that interest rate on that loan, then you can take them into bankruptcy. So it's a lot more clarity and visibility onto what you expected to receive in bonds. And that's what people like about bonds, is that, hey, you know what? I know what interest rate I'm going to get, rather than the uncertainty of what I might get in the stock market. So if you look at what Morgan talked about, these are bonds that are issued, let's say, by a high quality issuer like the U.S. government. Let's take the very, very short term. Let's look at 30 days. So these are called the 30 days U.S. Treasury bills. If you had invested over the past 90 plus years in these 30 days U.S. Treasury bills, if you look at the Matrix book, what you see is that over the long run, there has never been a negative calendar year when you would have seen losses in these bonds, which is very different than what you experience with the stock market. A lot less fluctuation in value. And by the way, you also earn 3-4% average annualized per year, which is ahead of inflation. So these treasury bills, in a way, are a counterbalance. If the stock market provides you with the big growth, these tend to be more stable. But the trade-off is that you're not getting paid as much. So what's the difference? Just to make it real, if you invest at 9-10%, well, your growth is going to be 11,000. If you earn 3-4 instead of 9-10%, same dollar, same time period. Again, you look at the Matrix book at the growth of the treasury bills. What you see is that over the same period, the dollar growth, instead of 11,000, would be a whopping $22. So quite significantly different in bonds. So are bonds appropriate? If you need stability, if you want to be careful, and I don't like to lose money, here's an amazing opportunity to get that. If you need to grow your money, you're young, you have another 40 years of a career. Well, perhaps in that case, being stable might not necessarily be the best thing for you. So to me, I really start with this idea that bonds absolutely have a role for certain people, because again, think about it. If you look at U.S. government 30-day treasury bills in the last 90 plus years, we have never seen a negative calendar year. So as an investor, it's not like you open your statement at the end of the year, it's like, I lost money. And that's remarkable, because very few investments can claim that. So that's the first thing, is that the bonds have a role, because there's no alternative, no other alternative that would actually, kind of over the long run keep you ahead of inflation, but also give you some earning based on a contract, and lending money. Now, you mentioned last year, and people got disappointed last year that the bond market lost, the returns were negative. You lost money in the bond market, and what exactly happened? How could you possibly lose money if we do have this contract in place? And it is quite interesting, because in 2021, even early 2022, let's say that you wanted to buy, and you had $100,000, and you wanted to buy some U.S. government bonds, and instead of 30 days, let's say it was 5 years. And at the time, these bonds were paying about 1% in interest. And if you had a 20-year horizon, let's say this is 2022 and you're looking into 2042, and you had this 1% bonds and you kind of roll them over four times through, at this 1% interest rate, what you would get is probably about, the 100,000 back at the end of the period. Plus, over 20 years, you'd get 20,000 in interest, and you can make interest on that interest. So it'd probably be another 22,000 for a grand total of 122,000. So if you looked at the bonds and you bought them early in 2022, you would have received 1%, and that 1% would have grown, and you can just get that money at the end. If you bought those bonds and you hang on to them, there is no loss because you're going to get the 1%. It's very likely you're going to get the 1% interest from the government, and then the principal at the back end. So again, it's not really, you can't say like I'm going to lose money if I hold on to those bonds. But what's interesting, Morgan, is that by the end of the year, newer bonds were not paying 1% anymore, but as interest rates went up, they were paying something, let's say about 4%. So now if you look at towards the end of the year, the new bonds are paying about 4%. So when they're paying 4%, if you had bought these bonds for 100,000, at that point, you can hang on to them and you'll be fine. But now you are presented with an option. Well, if I actually sell what I just bought at 1% and I now buy the 4% bonds, well, am I going to be better off? Because it seems like mine are slower. They only pay 1%, the new ones pay 4%. Well, it turns out that if you were to sell your bonds, you're not going to get the full money you paid because people are going to tell you, listen, your bonds only pay 1%. The newly issued one, they pay 4% because rates went up. So yours are not worth as much as they used to be worth it. So what happens is at that point, if you say, I'm going to sell them anyway, instead of getting 100,000, you're likely going to get something in the neighborhood of 86,000 because these prices are driven by math. So now it's like, okay, now I get the 100,000 instead of 100,000, I got 86. So I'm seeing a loss, and this is where the loss comes from if you were to sell those bonds. But that's the bad news. The good news is that you can now take the 86,000 and actually reinvest it in bonds that pay you 4%. So are you going to be better off sticking with these 1% bonds over the long run, or selling the bonds, taking the loss, reinvesting at 4%? Which one are you going to be better off? And when you do the math, here's what you find is that for the first 4 or 5 years, you're actually going to be worse off. You're going to be underwater relative to just hanging on to the 1% bonds. But after this break-even point, this time when it crosses, you're going to actually start being ahead. And by the end of the 20 years, you're going to have roughly about $189,000 in your account because again, these are bonds paying about 4%. So what's interesting, Morgan, is that do bonds still make sense in the portfolio even as you took a loss? Absolutely. If you have this 20-year horizon, you should be actually very happy in a way, not because of the loss that you incurred last year, but because now your bonds, instead of giving you 1%, they're now giving you 4%. And over the long run, you're going to end up with more money than if you had stuck around with a 1% bond if rates had stayed at 1%. So to me, do bonds still make sense? Absolutely, they still make sense for a certain group of people. And even if we saw the losses, does it mean it's a disaster for a bond investor? Not at all. Again, it's one of those things that's good news, bad news. And it might just be the case that this might end up being a very positive development for these long-term folks who have like a 20-year plan, and by the end of 20 years they might end up with more money with these newer bonds even as they took a loss last year.
Well, as an advisor, what we just spoke about, we generally know as inflation or interest rate risk with bonds, and that's why I'm a big proponent in many cases for clients not to have to manage this themselves. I think it's a very unique opportunity these days for clients to hire a bond manager. So, for example, uh, we typically include bond funds, multiple bond funds within a portfolio, and let the professionals figure out when to sell, when to buy certain bonds based on interest rates. And not only that, a lot of folks don't think about diversifying globally. It's not just the US yield curve, right? We've got yield curves in other countries that you could take advantage of. So that's one of my takeaways. I think the other thing is people think bonds are safe, but not all bonds are created equally, and
Right.
there are bonds you can invest in that can be very high risk and not safe. So you've really got to be careful on what kind of bond portfolio you invest in if you're looking for safety. And I think for sure in 2008, a lot of people found out they thought they had high credit quality bonds and they were very much down. And I'd just like to wrap this up with a point that you said that I think is very important. Look at the end of the day, to figure out whether or not bonds are appropriate for you or not, start with planning and figure out what your goals are. Would you agree with that?
I could not agree. That's the starting point that of any investment process. Talk to an advisor, come up with a financial plan, and only then you can decide what might be needed to actually give you best chances to accomplish those goals.
So, do bonds have, well, myth number seven, bonds have no role in a portfolio. And that is definitely not necessarily the case. I think the message here is you don't have to have bonds in your portfolio necessarily, but in many cases it might make sense. Apollo, very much appreciate your insights and love having you. Again, my name's Morgan Smith, the host here for Top 10 Investing Myths. I can be found at worthpointinvest.com. Apollo Lupesco, Dimensional Fund Advisors. You have a great day, and we'll catch you on the next video. Take care now.
All right, talk soon.